Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025, May-June, Paper 4-2, question number 2. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit for the paper is 1 hour. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. W Limited manufactures one product and operates at full capacity. It makes and sells 11,000 units every month. Per unit, standard data is as follows. So all of these are our budgeted values. We have the selling price, direct material, direct labor, fixed overheads. Then the company had always made the product in metal. Its cost rose suddenly to 7.8 per meter due to a worldwide shortage of the metal. Previously, the cost per meter was 4.6. The decision had therefore been made to make the product out of plastic instead from April 2025. The directors were unsure whether this would be a short-term or long-term change. We have the actual results for April 2025. Okay, let's take a look at our first part. Complete the following table to reconcile the standard profit for April 2025 with the actual profit using required variances. Enter each variance in either the favorable or adverse column as appropriate. Okay, so we need to start with our standard profit, then we need to adjust all of our variances and figure out the actual profit. So the first thing we need to calculate is our standard profit. And in this case, you have been given the working section as well, but it would be easier for me to perform the calculations within the insert itself. But you guys, please make sure that you show all of your workings in the designated space in order to get the markings correctly. Let's figure out the standard profit. So what we need to do is figure out the direct material and direct labor per unit values, because for selling price and fixed overheads, we already have the per unit values. For direct material, each unit required 4 meters and the cost per meter is 4.6. So in order to figure out the price per unit, we just need to multiply these two together. So 4 times 4.6. This results in the value of 18.4. Then we repeat the same process for direct labor as well. Each unit requires 3 hours of work and we need to pay 11 per hour. So that will be 3 times 11, which results in 33. Now let's figure out the profit per unit. We can just subtract all of the cost per unit from our selling price. So that will be 92.5 minus 18.4 minus 33 minus 17.9. This results in the value of 23.2. Now, in order to figure out the standard profit, we need to multiply the profit per unit to the number of units. So that will be 11,000 times 23.2. That results in the value of 255,200. Let's write it down. Now, we need to calculate the sales price variance. So as the name suggests, we will be comparing the selling prices per unit and we need to multiply the difference by the actual units. So the sales price variance will just be the actual selling price per unit minus the budgeted selling price per unit multiplied by the actual units. Okay, so for the actual values, we have the total sales and we have the number of units as well. So the selling price per unit will just be the total revenue 935,000 divided by the number of units 11,000. This results in the value of 85. So our actual selling price per unit is 85. Then the budgeted selling price was 92.5. Then we need to multiply it by the actual units, which is 11,000. This results in the value of negative 82,500. And in this case, it is negative because the actual selling price is lower than the budgeted selling price, which means that this results in an adverse condition for the business because we always want our selling prices to be as high as possible. So we need to include 82,500 under the adverse column. Now we need to calculate the material price variance, and again in this case as well, the name suggests that we need to compare the prices per meter. So this is the material price variance. We will start with the budgeted price per meter minus the actual price per meter multiplied by the actual quantity, which is the total actual materials that we had to purchase. So the budgeted price per meter is 4.6 in this case. Then the actual price is given to be 2.5 per meter. Now we need to figure out the actual meters. Remember that this total value, 115,500, will be calculated by multiplying the actual quantity, which is the total meters, by the price per meter of 2.5. So the actual quantity will just be 115,500 divided by 2.5, which results in 46,200. This results in the value of positive 97,020. So in this case, it is positive because the budgeted price is higher than the actual price. And we're talking about material in this case, which is our cost. So the actual cost is lower, which results in a favorable condition for our business because we want to minimize our cost so that the profit will be higher. So we need to include 97,020 in our favorable column. Now we need to calculate the material uses variance. So in this case, we will be comparing the actual quantity to the budgeted quantity. So we have the material uses variance. So in this case, we will be comparing the budgeted quantity, but this will be the budgeted quantity per unit minus the actual quantity per unit. Then we multiply it by the budgeted price per meter. Then we multiply it by the actual units. Okay, so the budgeted quantity is that we expected us to need 4 meters per unit. So that is our budgeted quantity. Now for the actual quantity per unit, we have the total value. This 46,200 is for the total of 11,000 units. So in order to get the value per unit, we can just divide it by 11,000. This will result in 4.2. So we actually required 4.2 meters per unit. Then the budgeted price per meter, we already have it 4.6, and the actual units is 11,000. This results in the value of negative 10,120. And in this case, it is negative because we required a higher actual quantity. And again, we're talking about material, which is a cost. And if we require higher quantity, it means that we will have to pay a higher cost, which will result in an adverse condition for the business. Now we need to include 10,120 in the adverse column. Then we need to calculate the labor rate variance. Again, labor rate variance is similar to material price variance. We will just be comparing the rate per hour. So we have labor rate variance. And the formula will be the same as well. But instead of price, we will be comparing the rate. So budgeted rate minus the actual rate. This will be the rate per hour. Then we need to multiply it by the actual hours. Okay. So the budgeted rate per hour was given to be 11. Now for the actual rate. Okay, in this case, we have the actual hours instead. So times 39,600. So we will repeat the same process. In this case, we have to calculate the actual quantity because the price per meter was given. But for hours, we'll just do the opposite. So this total, 443,520, is just the product of the actual hours, which is 39,600, multiplied by the actual rate per hour. So the actual rate per hour will just be 443,520 divided by 39,600. This will result in the value of 11.2. Okay. This results in the value of negative 7,920. And in this case, it's negative because the actual rate was higher than the budgeted rate. So we had to pay a higher amount. And in this case, we're talking about labor, which is again an expense. We wanted our expense to be as low as possible. But in this case, we had to pay a higher amount, which results in an adverse condition for the business. So we need to include 7,920 in the adverse column. Then we need to calculate labor efficiency variance. So labor efficiency variance is equivalent to the material uses variance. In this case as well, we'll be comparing the hours. Let's write it down. So we have labor efficiency variance. The formula will be the same. Instead of quantity, we'll now have the hours. And this will be the hour per unit. Then we need to multiply it by the budgeted rate and by the actual units. Now the budgeted hour per unit was given to be 3. In this case, we have the total actual hours In order to figure out the actual hours per unit, we just need to divide it by the number of units, which is 11,000. So that will be 39,600 divided by 11,000, which results in the value of 3.6. Then the budgeted rate was just 11, and the actual units is 11,000. This results in the value of negative 72,600. And it's negative because the actual hour is higher than the budgeted hour. Since they are working extra hours, it will mean that we have to pay a higher amount for our labor. So the expenses will be higher, which will result in an adverse condition for the business. So we need to include 72,600 under the adverse column. And in this case, I've been writing down the formula so that if you get a positive value, it will result in a favorable condition. And if you get a negative value, it will result in an adverse condition. Okay, now for the last one, we need to calculate the total fixed overhead variance. So we have the total fixed overhead variance. Whenever we are calculating the total variances, it should just be the difference between our flexed values and the actual values. So it will be flexed minus actual. And flexed is just the budgeted values per unit multiplied by the actual units. But in this case, the actual units and the budgeted units both are the same. So our flexed fixed overheads will just be the budgeted value per unit, which is 17.9. Then we will multiply it to the actual number of units, 11,000. So that will be 17.9 times 11,000. And for the actual fixed overheads, that is 212,000. Now, this will again result in a negative value of 15,100. And this is negative because the actual fixed overhead is higher. Again, fixed overhead is an expense. We wanted it to be as low as possible, but since the actual value is higher, it will result in an adverse condition. So we need to include 15,100 under the adverse column. Now, we first need to figure out the total favorable and total adverse variances. For favorable, there's only one value, so the total will be 97,020. For adverse, the total will be 82,500 plus 10,120 plus 7,920 plus 72,600 plus 15,100, which results in the value of 188,240. Now, whenever we are reconciling the standard profit to the actual profit, we add the favorable values, we subtract the adverse values. So we have to subtract this amount. Now, this total will just be 97,020 minus 188,240, which results in negative 91,220. And remember that within these shaded boxes, you're not supposed to write anything. So now the actual profit after reconciliation will just be 255,200 minus 91,220, which results in 163,980. Now we can also verify our workings by calculating the actual profits from the given actual values. So we can just subtract all of these costs from the sales value. So that will be 935,000 minus 115,500 minus 443,520 minus 212,000, which will again result in the value of 163,980. Since we got the same value for the actual profit, it means that all of the calculation for our variances are correct. Now again, make sure that you show all of these calculations within the working section. I just did it here because it would be hectic for me to scroll back and forth. Okay, that's all for the first part. Let's move towards the next one. We need to discuss whether variance analysis is useful in this situation. So in this case, under our information, there was changes in the material that we used. Previously, the production used metal as its material, but since there was a worldwide shortage of the metal, the decision had been changed to make the product out of plastic instead from April 2025, and the directors are still unsure whether to use plastic or move back to metal by paying a higher price for the per meter value. So the very first thing we can write about whether the variance analysis is useful in this situation is that it is showing us the difference between our budgeted and the actual values, especially caused by the change in materials, because we have calculated both the material price variance as well as the material uses variance. Let's write it down. So it shows the differences between the budgeted and actual values caused by the change in materials. And this is a format, so we need 4 comments. And also the keyword here is discuss. So we do not need any one final decision. We just need to write down various comments about it. Then we can also talk about how the changes in material will have impact on other of our variances. Especially we can talk about the labor variance as well. We can see that the labor efficiency variance is adverse by a really high amount, 72,600. So they're not really efficient with working with the new material plastic because they are not experienced with it, or maybe there is a higher wastage. Let's write it down. So it shows how it affects other variances. For example, worker being less efficient as they are not experienced with the new material. Okay. Then for the next one, since we've already done variance analysis and we've figured out whether the variances are adverse or favorable, now it will indicate the changes that the company needs to make in order to improve the outcomes. Let's write it down. It indicates where changes can be made to improve the outcome. And improve the outcome in the sense that we want to convert all of our adverse variances into favorable variances. And as a result, this will help plan more realistic and attainable goals. So it will help plan realistic and attainable goals. That is all for the second part. Let's move towards the next one. Now we need to advise the directors whether or not they should continue with the change in material. We need to justify our answer and support it with relevant calculations as well. So this is advice. So we need to have one final decision, and this is of 7 marks. So we need 6 different comments as well. Now the very first thing we can do is do our calculations. And in this case, the impact will just be in the reduction of profit. Let's take a look above. So if we were to continue with metal, we would now have to pay 7.8 per meter as compared to the previous 4.6 per meter. So we can first figure out the increase in price per meter. Let's do that. So the increase in price per meter will just be our new price 7.8 minus the previous price 4.6. This will result in the value of 3.2. This is per meter change. And we need 4 meter per unit according to our standard value, and we have been producing 11,000 units. Since we have increase in cost, it will result in decrease in profit. So let's figure out the decrease in profit. So it will be by 3.2 per meter. We need 4 meters for 1 unit, and we have a total of 11,000 units. So the total decrease in profit will be by 140,800. And this is the decrease in profit based on our budgeted values. So based on material metal. Now let us compare it to the actual reduction in profit. So the new actual profit is 163,980. Our previous standard profit or the budgeted profit was 255,200, which means that the actual reduction in profit was by 91,220. Let's write it down as well. So the actual reduction or decrease in profit is by 91,220. So we can see that the actual decrease in profit is lower as compared to the decrease in profit that would occur if we still continued with metal, but this is based on plastic because we converted to using plastic as our material from the month of April. Now this will be all of our relevant calculations, and calculation marking will be 2 marks. So now we need to have 4 additional comments. 2 for why we should continue with the change in material, 2 for why we should not be continuing with the change in material. Now after we change to plastic, we can see that we are still earning a profit. So it means that our production is still profitable. Let's write it down. The product is profitable even after the change in material. And then we can see that if we were to continue with metal, then our profit would reduce by a higher amount. So it means that after changing our material, the profit is higher than if the business uses metal. Let's consider that. Profit is higher than if business uses metal based on the given prices. Now we need 2 different comments on why they should not continue with plastic material. We are changing from metal to plastic, so it might definitely impact the quality of the product negatively. So the change in material might impact the quality of the product adversely. Then one more comment is that since we are using plastic, it might have some environmental concerns as well. It might be more degrading to the environment. Let's write it down. There may be environmental concerns when using plastic material. All right. Now, based on these factors, we need to make a final decision. So I would advise the directors that they should continue with the change, that they should not continue with the change in material because, again, the first thing is that the quality will be impacted, and as a result, the brand image may be damaged. Let's write it down. The directors should not continue with the change in material as the brand image may be damaged by switching to plastic material from metal material. Alright, that is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.